AWS just accelerated for the fifth quarter in a row and expanded margins to 39%, which is the exact opposite of what every bear predicted would happen when the AI spending hit. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Amazon, ticker AMZN, for the second quarter fiscal 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. So revenue came in at 2.34% above estimates, landing at $200.6 billion, and that is up 20% year over year. A $200 billion quarter growing 20% is genuinely wild at this scale. And on EPS, the headline was plus 215% above estimates at $5.75 per share. But before we celebrate, most of that came from unrealized gains on their Anthropic investment. Strip that out, and clean operational EPS was closer to $2, which is still a solid beat, just nowhere near the plus 200% monster the headline suggests. So on the beat itself, and remember, we are grading against the clean numbers, not the Anthropic inflated headline. This earns a B. Revenue was a modest beat, and the clean EPS beat around 20% above last year is strong but not eye-popping. And on consistency, this earns an A. Amazon has been beating quarter after quarter, and this is now the fifth straight quarter of AWS acceleration. That is not luck, that is a track record. The headline number for me is AWS. It grew almost 37% year over year, and that is the fastest growth they have posted in 18 quarters. This is the fifth straight quarter of acceleration, which just does not happen by accident at this size. And that ties into the backlog, which now sits at $496 billion in signed customer contracts. Management said capacity is already reserved into 2028, and Jassy openly said AWS could become a $1 trillion annual business over time. On top of that, AWS operating margin hit 39%. Even after stripping out the one-time energy gain, that is still over 5 percentage points of expansion year over year. This directly contradicts the entire bear thesis that AI workloads would crush AWS margins. Then you have the AI services business and the custom chips business, each crossing $25 billion in annualized revenue, both growing triple digits. Anthropic and OpenAI both signed multi-year commitments for their Trainium chips, which is a huge validation. And advertising quietly grew 26% to almost $20 billion. That is a massive high-margin revenue stream that most people are not even talking about. So on profitability, I am giving this an A. AWS margins expanding while spending record amounts on infrastructure is exactly the kind of result that separates a great business from a good one. The biggest thing on the negative side is free cash flow. Trailing 12-month free cash flow flipped from a positive $18 billion inflow last year to a $7.6 billion outflow now. That is a massive swing, driven by the huge jump in capital spending. And that ties directly into the CapEx guide, which just got raised from around $200 billion to around $220 billion for the year. Jassy openly admitted the driver was inflated prices on memory chips, hard drives, and SSDs. That is a real structural cost headwind. Then on the outlook, Q3 revenue growth is guided to 9 to 12%, which is a massive step down from the 20% they just posted. Even adjusting for Prime Day timing shifting out of the quarter, the underlying growth is still a clear slowdown. Q3 operating income is guided to a midpoint of $24.5 billion, which is below the $27.5 billion they just posted. Even after removing the one-time benefits from Q2, That still implies sequential margin compression heading into the next print. And the international segment is still stuck at only 4% operating margin, way behind North America and AWS. Transportation costs are elevated from fuel inflation and driver capacity constraints on longer routes. So on guidance, I am at a C+. The Q3 setup implies a real sequential slowdown in both revenue growth and margins, and the market is going to focus on that. And on red flags, I am landing at a C. The free cash flow outflow is real, and if memory prices keep climbing into next year, the cash burn could get deeper before it gets better. Look, this print is really a tale of two stories. A WS accelerating for the fifth straight quarter to almost 37% growth, expanding margins to 39%, and building a $496 billion backlog is one of the best infrastructure results I have seen in years. But the free cash flow flipping to a $7 billion outflow and the Q3 guide implying sequential compression are real concerns that the market will focus on in the near term. Putting it all together, I am giving this print a B. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. I'm not chasing strength here. The third quarter operating income outlook implies things slow down from the boosted $27.5 billion we saw in the second quarter, so I'm letting the market digest that first. A 5 to 8% pullback is where I want to start a position. There are 2 catalysts I'm watching that could reaccelerate the story. The Amazon LEO satellite internet launch is coming this year, and any new commentary on Trainium chips being sold to third parties matters. Either one could put a fresh bid under the shares. That said, this is a high quality name. If I sit on my hands waiting for a perfect entry and miss the whole move, that's a bigger mistake than paying up a little bit. I'd rather nibble than freeze. So for me, wanting in, I wait for a post-earnings dip. I'm not selling any cash secured puts before the third quarter print in October. That guidance sets up a known event risk that isn't priced into the options yet, and I'd rather let it come out than sell into it blind. When I do sell, my strike floors sit meaningfully below where the stock is trading. The trailing free cash flow outflow of $7.6 billion is a real vulnerability if sentiment shifts away from the AWS story, and I want room to survive that. The best setup this name offers me is selling after the drop, when implied volatility is still elevated but starting to normalize. I get a higher premium and a lower strike price at the same time, which is exactly what I want. So on the put selling side, I sell cash secured puts into post-earnings weakness. This print materially strengthened the long-term thesis for me. AWS accelerated for a 5th straight quarter. The AWS operating margin came in at 39%, and both the AI services and custom chip businesses are at $25 billion run rates or higher. The $496 billion backlog is the piece that validates the whole infrastructure story for me. That's real demand visibility, and it's not something I want to be short of if I already own shares. The only reason I'd trim here is if my position size drifted well above target because of the run into earnings. Otherwise, if I'm adding, I anchor my entries to a pullback around the third quarter outlook rather than chasing today's price. So owning the shares, I hold and add on weakness. If my current strikes are getting pressured, I'm rolling them up and out. Jassy explicitly framed AWS as a potential $1 trillion revenue business, and getting called away at my pre-earning strikes would be a real mistake, given where the ceiling just moved. If my existing strikes are safely out of the money, I just hold them through the third quarter print. The sequential margin compression could cap near-term upside, and that lets my calls decay and expire worthless the way I want them to. For any new covered calls I write, I keep the strikes wide enough to survive the market repricing this stock on AWS strength, but still tight enough to harvest some premium if the third quarter outlook drives weakness. It's a balance. So on my covered calls, I roll strikes up and out. I'm holding my long-dated calls and thinking about rolling them up and out. The $496 billion backlog growing triple digits year over year is exactly the demand visibility I want when I own longer-dated exposure through a heavy investment window. Jassy said out loud that AWS could become a $1 trillion revenue business. That kind of framing from the CEO raises the ceiling on where this stock can go over the next 12 to 24 months, which is my leaps window. Management laid out that their servers break even in under 3 years with a 5 to 6 year useful life. So the free cash flow headwinds I'm seeing now translate into compounding cash flow in 2028 through 2030. I only trim if my delta got uncomfortably large. So with my leaps, I hold and roll up and out. The call validated my original thesis in a way that few recent Amazon prints have. A WS accelerating for 5 consecutive quarters is not a data point that reverses easily, and the backlog gives me 18 to 24 months of forward visibility. The one thing that gives me pause is the raised capital expenditure outlook, going from $200 billion to $220 billion because of memory inflation. If memory prices keep climbing into 2027, the free cash flow low point could get deeper and push the payoff out further. So I size any adds with that scenario in mind, but cut loss framing doesn't apply to me here. The AWS story is stronger, not weaker, than what my entry thesis assumed, so averaging down on any weakness driven by the third quarter outlook is defensible. So if I'm underwater or adding, I average down on Q3 weakness. So bottom line, this print earns a B from me. The AWS story got materially stronger, but the cash burn and the Q3 setup mean the road from here is going to be bumpy. That is my take.